Hi, my name is Esteban Perez. I am a business advisor with the Ihcc, or the Illinois Hispanic Chamber of Commerce, specifically in the Illinois Small Business Development Center at the Chamber of Commerce. My specializations are in accounting and finance, and I help small business clients every day get a little bit more of a grip on how to organize the business, maybe even just how to incorporate, and then how to prepare for tax season by organizing the business effectively. And here we have a brilliant EY team, starting with Melissa Miller, Laura Rossi, and Martin Rule, who are going to present a little bit more on taxes, entities, and then how these different entities have different tax implications. So feel free to ask any questions during the presentation so that we can have them ready to go in the chat. And you can access the chat by moving the mouse over the screen, and then it's going to be a button down below called chat. There you can ask the team, the Ihcc team, any questions during the presentation if you're having any technical difficulties, and then as well as content-related questions straight to the EY team. At the end of our hour-long presentation, we're going to break down into questions, and I'm going to be feeding the EY team questions one by one. So once you think of it, just put it in the chat, and then I'll see it at the end. So yeah, I think you can take it away, Melissa.
Okay, good morning, everyone. Glad to be with you today. Melissa Miller is my name. I am a senior manager in our indirect tax practice for EY in Chicago. So I work with clients on a variety of transaction-based consumption taxes like sales use tax, gross receipts types taxes. And I'll be talking in the middle of the presentation about considerations and things that you should be thinking about. Laura Rossi will kick off our presentation here. So maybe Laura, if you could provide an introduction, and then Martin, and then we can get things started.
Sounds good. Thanks, Melissa. Hi, everyone. I'm Laura Rossi. I'm a managing director in our Chicago EY private practice. Within that practice, I deal mainly with individuals, multi-generational families, high net worth individuals, and corporate executives. Anything and everything tax related, whether it be tax return filing or tax planning. And I look forward to speaking to you guys today. Martin?
Thank you, Laura. And my name is Martin Rule. I'm a senior manager in the Chicago office of EY. And my area of specialty is employment tax. And I will spend some time with you this morning talking about the importance and the requirements for employment tax compliance.
All right, so let's get started. As a reminder, this is for educational purposes only. So anything that we say obviously is just to better inform you as it relates to tax issues and tax filings. We have a full agenda today. I will be covering entity formation as well as filing requirements. Melissa will then touch base on some issues regarding sales tax as well as business considerations, and Martin will be focusing on the payroll side of things. Again, like it was said, any questions, please feel free to put those in the chat. There is a lot of information in this first section, and I want to make sure that everybody is aware. We will share the slides as well as the additional information that I'll go through after the presentation. So let's start talking about entity formation. And so first and foremost, this is probably the most important piece besides you deciding that you want to start a business. The second, then I guess, most important piece would be what type of entity are you going to choose? And when you start thinking about the type of entity that you're going to use for your business, there's a couple of things that come to mind. Number one, how are those taxes going to be reported and how are those taxes going to be paid? In addition to reporting the income and expenses with regards to gathering all the information as well as making sure that it's being reported properly. Sometimes your entity choice will also affect the ability for you to raise money, whether that be from outside investors or even from a bank perspective. And I think one of the biggest and most important things is personal liability. Obviously, when you start a business, you are hoping that it's going to be successful and succeed, but you may run into issues along the way. And so sometimes finding that clear separation between your personal side of your assets as well as your business side of assets is very important. Next slide. So let's start with the most, the easiest, I should say, type of entity, and that is a sole proprietorship. That basically means you have one owner, typically yourself. It's the easiest to form, and you, because you are the sole owner, you have complete control of your business. Now, the only thing with the sole proprietorship is that it's not considered a separate business entity. So you are operating as your business, meaning that there's no separation between the business assets and liabilities as well as your personal assets and liabilities. So keep that in mind, because again, if something happens on the business side, your personal assets may be accessible for any kind of lawsuit or anything along those lines. Typically, it is difficult to raise money, meaning get money from other investors or banks, because sometimes they are hesitant to lend based on your credit history. If you have a sole proprietorship, your profits and losses are reported directly on your personal income tax returns. And typically that's by using Schedule C, which we'll go over an example later on. You are also subject to self-employment tax if you do in fact have income from that business in a given year. But on the same point, it can be a good choice, especially if you are starting out or you want to test a business idea before really kind of jumping in feet first. This is kind of, I would say, dipping your toes in the water to see if this is really kind of how you want to go about with your business. Next slide. The next type of entity is partnerships, and there are two types of partnerships that you can actually choose from when you're setting up a business. The first is considered a limited partnership, and that is basically there is one general partner who has all the unlimited liability, meaning everything is basically in their basket or their court from a risk perspective, and all the other partners in that partnership are considered a limited partner, and therefore they have limited liability and limited control over the actual company itself. And a limited liability partnership, or an LLP, that basically says that everybody, all owners, all partners have limited liability. And each partner in that entity is protected from debts against the partnership and isn't responsible for any other actions that the partners may take. A partnership is considered a flow-through entity. And so what that means is that the partnership itself will not pay tax. Instead, the partners are responsible for reporting all those income and expense items, and therefore paying that respective tax on their individual tax return. Each partner will receive a Schedule K-1 that reports their share of the income or loss. And again, we've got an example that we'll go through a little bit later to show you how that works. In the partnership perspective, the general partner does need to pay self-employment tax. And again, if you've got multiple people that are looking to form a business together, partnerships might be a good option because they do work well for businesses with multiple owners. Next slide. On the same front, we also have limited liability companies, or LLCs. Now, these are quite common, and I will say that a lot of my clients that I work with do have and use LLCs for their businesses. The biggest piece is, again, it's a limited liability company, meaning that they are protected, or that you will be protected from your personal liability in most instances with regards to the business. So in case something happens in the business, either it goes bankrupt or there's lawsuits, again, your personal assets won't be at risk. If you have a multi-member LLC, meaning there's obviously more than one member, you will need to file a return, like a partnership return, and have all the profits and loss pass through. Again, it's a flow-through entity like a partnership. However, you could also have a single member LLC. And in that case, if you are a single member LLC, you don't need to file a separate return per se. You would actually report all that information on your Schedule C with regards to your individual income tax return. On the LLC front, state taxes will vary. And the one thing that I do want to mention is, so from a flow-through perspective, I said that all profits and losses are basically passed through and reported on the individual's income tax return. In the state of Illinois, if you have a flow-through entity, Illinois does assess an additional 1.5% replacement tax on any income that is generated by that business. And so there will still need to be a state filing and potentially some state taxes that need to be paid because of that replacement tax. For the LLC, again, all the members of the LLC are considered self-employed, and they do have to pay self-employment tax on any income that's generated from that LLC. And further proving my point that LLCs do help protect from personal liability. And so that's definitely a good choice for those individuals that want to keep that separation between the business side and the personal side. Next slide. C corporations. So C corporations are another type of entity. Now, this is not a flow-through entity, and it is an entity that is separate from its owners. Think of your companies that are on the stock exchange or those that you will buy stock in, like Starbucks, McDonald's, etc. Those companies are C corporations. They do not pass through their income and expenses to their owners. Instead, they are responsible for paying their own income tax on their profits. So the tax is assessed at the corporation level. And then the dividends that are paid out or distributions that are paid to those shareholders are also taxed on the individual side or on the recipient side. So ultimately, think of a C corporation as potentially being a double tax entity, because again, you've got tax on the profits, and then you also have tax on any dividends or distributions that are paid out to the shareholders. C corporations are a great way for capital to be raised because you can sell shares of the corporation to raise money. And typically C corporations are good if you have, again, the need to raise money by selling stock, or if you are planning to potentially go public or be sold. Next slide. S corporations. So an S corporation is a corporation, but it is a different type of corporation, and it is considered a flow-through entity. Now, in that case, there is no tax at the corporation level, and you must make an election to file as an S corporation in order to have that flow-through work. You have to have a couple of rules here. You have to have no more than 100 shareholders if you are setting up as an S corporation. Everybody must be a US citizen that is a shareholder in that S corporation. And for purposes of taxation, again, it's going to vary at the state level because each state is going to be different as to how they tax that flow-through entity. Next slide. So a couple of things before we go into a little bit of a just general case study here. Yesterday was the due date for extensions as well as filings if you weren't going to extend for any partnership and S corporation returns. The extensions will extend the due date of the return out 6 months. And one thing to note is that although the due date is extended, the payment of any tax that might be owed with that respective form is not. So all payments must be made by that initial date, but the filings are extended out 6 months. So again, the partnership, the Form 1065 and the 1120S form, which is the S corporation filing form, those are due yesterday, but can be extended up until, September 15th. On the individual side, which is the Form 1040, we still have another month until April 15th when those are due. However, those can also be extended through October 15th. And the same thing with the C corporation, which is the Form 1120. That's an April 15th due date with an extension to October 15th. On the state side, every state is going to vary with regards to when those returns are due at the state level. Generally, they follow federal deadlines, but they could also be a month or two behind. So definitely look to see from the states that you're filing in or are required to file in what those deadlines are. Generally, most states will start with federal taxable income when they are computing the tax at the state level. And Melissa will talk a little bit more about this from a sales tax perspective as well as location. But basically, anywhere that you the entity has nexus, meaning that there is a potential location for sales, property, payroll, etc., there may be some state tax implications. And so definitely kind of keep an eye on where those sales are occurring and how often those are occurring. Next slide. All right, so we're going to start with a case study on the sole proprietorship. So Joe Smith starts a business. He starts Joe's Good Eats LLC, and he owns 100% of this LLC. So basically this is a single member LLC or a sole proprietorship. And again, he is a single member. It's a disregarded entity. So there's no separate tax form filed. Everything is going to be reported on his Schedule C. Now, from an income perspective, that basically means that all of the cash, property, and anything that was received from a service standpoint is considered income. And anything from an expense perspective, ordinary and necessary business expenses that are incurred while producing or wanting to produce that income are considered expenses. What I will say is that it is important and imperative that you are able to keep track of your expenses, everything that's related to the business, and whether you're using Excel, whether you're using a software like Quicken or QuickBooks, basically taking inventory of your expenses is going to help you in the long run from a tax perspective, because even if you don't make income in a year or if you don't have net income in a year, you are still able to take expenses or take a loss on your business. So again, like I said, the profit or loss is reported on Schedule C, which will then flow throughout the tax return. And then in general, that tax for your business is calculated, including your total income. So actually, Melissa, can you go to the next slide? One more thing I want to touch on before I switch it over. The other thing I wanted to point out is self-employment tax. So I mentioned that if you are considered an LLC, if you're an LLC member, or if you're a sole proprietor, you are going to be subject to self-employment tax on your income. And what that basically means is that you are going to pay both the employer and the employee portion of the Social Security and Medicare tax on your income. You do get a deduction of half of that self-employment tax amount. That's basically the employer portion. You do get that as a deduction, but basically you're paying in both sides of the employer and the employee tax. So think of it as if you're receiving a wage, or if you're receiving a salary, you had a job that you got a paycheck from every week, every 2 weeks, whatever it is, your employer is withholding your employee portion of the Social Security and Medicare tax, because that is required to be paid into the government. If you are a sole proprietor or again an LLC member, you also have to pay that Social Security Medicare tax, but you're going to pay it in when you file your return or through estimated tax payments. So we are going to switch over to the case study, and what I want to show you all is a couple of things as it relates to what the tax return might look like. And hopefully, no, that doesn't, hold on, sorry guys. It disappeared. You guys can't see my PDFs, can you?
Yeah, so far I can see the 1040.
Oh, okay, perfect. I don't have the little notification up here. Perfect. Okay.
Okay.
All right. So here is Joe Smith's 1040. And basically what we've done here is we've kind of just put a general 1040 together. Joe has a job outside of his business. And so he does have some wage income, which we've reported here. But what I want to focus on is his Schedule C. And so if we scroll through, this is what the Schedule C looks like. And effectively, there's a couple of items that need to be focused on. Number one, obviously, if you are an LLC or you have a separate business name as well as a separate EIN, you should be including that on that form in addition to your name and your Social Security number. You also should be indicating what type of business you have, as well as the 6-digit NAICS code that actually is accessible in the IRS instructions for Schedule C. Your type of accounting method, and again, it's going to vary based on what you're doing or how you're keeping your books and records. And if you materially participated in this business. Now, generally, if you are the sole proprietor, or if you are basically doing all of the work in that business and you're reporting this income on your Schedule C, you are in fact materially or actively participating in that business. Line I, did you make any payments in 2020 that would require you to file forms 1099? So this is if you had any type of employee or any type of contract labor, or paid a dollar amount for services over $600, you would have to indicate that yes, you filed, and they would want to make sure that you did in fact file those forms. Well, let's get back to Joe. So Joe made $15,000 in total sales or gross income for the year. He also had some general expenses, advertising, some depreciation on equipment, some insurance, not health insurance, paid some legal fees, had to pay some rent, supplies, etc. So at the end of the day, Joe had $13,000 of expenses. So his profit is $2,000. Now, the question is, where's that $2,000 go? So we have Schedule C. We're actually going to take this to Schedule 1. Now, Schedule 1 is going to list all of your additional income items as well as your adjustments. So line 3 from Schedule C, it says business income or loss. There's our $2,000. Now, we also have to assess self-employment tax on this $2,000. And that's where this number comes into play. And I'll show you that form right now. So on the self-employment tax side of things, again, Joe has profit from his Schedule C. So we've got the profit reported here of $2,000. The calculation actually takes, for self-employment income purposes, takes 92.35% of that profit. And then it subjects that dollar amount, or that $1,847, it subjects that to the 12.4% Social Security, again, 6.2 employer, 6.2 employee, and then the 2.9% Medicare, which is 1.45 employer, 1.45 employee. The total self-employment tax for Joe is $283. And again, like I said before, he gets a 1/2 deduction for that self-employment tax paid on his individual income tax return. So now we're going to go back to that Schedule 1, which is going to show you, here is that deductible part of self-employment tax on line 14 of $142. Now, these two line items here are actually going to flow back to the actual tax return. So you can see here, other income, $2,000, adjustments to income, that 140, should be 142, the calculation was off in the software. It didn't like 140, 150. So at the end of the day, our adjusted gross income is $36,859. Again, he's got his wage income, he's got his business income, we get the deduction for self-employment tax. But then you can see here, there's this line 13, qualified business income deduction. And there's another $400 of deduction that's actually coming into play here. So let's take a look at where that comes from. So this QBI, as we refer to it, this QBI deduction actually is a result of the Tax Cuts and Jobs Act changes back in 2017, that was passed in December of 2017, that basically says if you have income from a qualified business, and I'm not going to go into all the details about what a qualified business is because that could take this whole entire hour. But basically, let's assume that Joe's Good Eats is a qualified business. And again, the qualified business income is $2,000. Joe's Good Eats, or Joe basically, will get a 20% deduction on that qualified business income. So basically 20% of that, or $400, will flow to his tax return because he'll get a deduction for that QBI income. So that's the piece where a lot of times people tend to forget about that. So definitely make sure that you're looking into all of the implications with regards to the qualified business income deduction. So at the end of the day, Joe's income taxes just over $2,700. We have to add in his self-employment tax, which is the $283. And so his total tax for the year is $2,975. Now, if we go back to the presentation, so Melissa, you can take back my screen. We're going to go through what the partnership example is going to look like. You're having the same issue as I was, Melissa. That menu just disappeared. Yep. All right, you can go to the next slide. Perfect. Okay. So now Joe decides that he wants to start a business, but he wants to form it as a partnership. So Joe Smith and Mary Baker form JM's Good Eats. They each are contributing $50,000 of cash to this partnership, and therefore each of them is going to receive a 50% interest. Now, again, because this is a partnership, they have to file a partnership income tax return, and each of them as partners will get a Schedule K-1 that's going to report their share of income or loss from JM's Good Eats. All right. So let's go to the 1065. And here you can see that we have the partnership return. Now, again, this is a very general, just easy off the cuff partnership tax return, just to show you kind of how everything flows and it all works. So again, we've got to put the business activity and the code in there, what accounting method we have, how many K-1s there are, what the total assets are. And again, JM's Good Eats, $15,000 of gross income, sales, et cetera, for the year. But in this case, their expenses were a little bit more than what we saw on the other example. So they had $21,000 of expenses. Therefore, they're actually having a $6,000 loss. Now, as we work through the return, the 1065 is 5 pages without any attachments or schedules, et cetera. And so it's important that each page is reviewed, not only to indicate what type of entity this is, but also if there's ownership that owned by, more than 50% or more by one person or two individuals. There's a separate schedule that has to be completed. A lot of questions that need to just be looked at for purposes of completing based on your situation. If there is a partnership representative, meaning somebody that's going to be acting on behalf of the partnership, if it's not the general partner per se. And then page 4 and 5 are kind of the income and reporting information. So page 4 is going to be Schedule K, which is going to show all of the partners' information in total that's going to be used to generate the Schedule K-1s. Now, again, in this case, the only line item we have is line 1, which is that ordinary business loss. And that then flows to page 5. So up here, you can see we've got the net loss of $6,000. And we've got 2 line items here, partner type, general partner or limited partner. Now, this is an LLC, this is a partnership. And so for purposes of this, Joe is acting as the member manager or the general partner of the partnership. Mary is a limited partner. They started the business during the year, so there's nothing on the balance sheet at the beginning of the year. But then at the end of the year, they still have $94,000 in cash. And this is how this worked, because they both contributed $100,000, but their loss for the year is $6,000. And so they've obviously had to, they received income, they paid their expenses. So they lost $6,000, meaning that $94,000 is what's left in the bank. And that's also what is considered their capital accounts, or what they have into the partnership. And this is reflected on the K-1. So each of them is going to get a Schedule K-1 that's going to show their share of the ordinary loss, that $3,000, as well as what their capital account is. And so from a partnership perspective, again, each person contributed $50,000. They're allocated that $3,000 of loss. Therefore, they still have a $47,000 interest or $47,000 into the partnership. One thing I want to point out here on the partnership K1, this 1065 for the Schedule K1, self-employment loss is showing $3,000. Now, this is important because if we go now to Joe's tax return, if he was reporting from a partnership perspective, there's a couple of items here. Number one, the difference, we're showing a loss here on line 8 instead of the income of $2,000 that we had from the other example. And there's no QBI deduction, and there's no deduction or adjustment for self-employment tax. That is because of the following. Number one, if we have self-employment income, we have to pay tax on it. If we have self-employment loss, there's no self-employment tax owed. So that's why, for example, for purposes, this form wouldn't generate if you had a loss, but I wanted to show you that obviously there's nothing to compute any kind of tax on because there's no income. On the same front, from a QBI perspective, that qualified business income deduction, there is no deduction allowed because there's no income allowed. However, the laws do allow you to carry forward any loss that you may have generated in a qualified business to be used at another time when you actually have income, and it'll offset it. So definitely don't forget that even if you don't have income, you could potentially have a carry forward that you would need to keep track of. For reporting purposes, the difference is there's no Schedule C on this return because, again, Joe owned this as an investment in a partnership. Therefore, he's going to report it on this schedule, which is Schedule E, and that's going to go on page 2 in this top section, where you have to list out the entity's name, what type of entity it is, as well as what the income or loss is. Now, again, remember, Joe is actively participating in this business. He's an active partner, so he is considered non-passive. Therefore, his loss is going to flow through as non-passive. Now, don't get confused that this does not show the negative sign from a loss perspective. This is how it is reported on a tax return, and the loss will flow through automatically and show as a negative number here. If we take it one step further and go from the S corporation perspective, I'm going to skip going back and forth, Melissa. So with regards to this example, again, same concept, but it's an S corporation. So Joe and Mary each contribute $50,000 to the S corporation. And in return, they each get 50 shares of the S corporation. Now, a couple of things to note here. This line G is the corporation electing to be an S corporation beginning with this tax year. We've indicated yes. And if you have already filed that S election, which is Form 2553, then it has to be included and attached. If you have not already filed that, it needs to be filed, or the return needs to be filed before March 15th in order to have that S election, apply. Same information in terms of the dollar amounts, the expenses. We're showing an ordinary loss of $6,000 on this S corporation return. Again, questions and certain information needs to be completed as it relates to the S corporation itself. S corporation also has a Schedule K that's going to report all of the items that are going to be allocated out to the shareholders. Balance sheet, same thing, $94,000 end of the year cash because of the $6,000 loss. And the only difference is this AAA account, which I'm not going to get into, but I at least wanted to have it on here to show you guys that this is what the S corporation return looks like. This is the K1, couple of differences. Number one, there is no self-employment section because the S corporation shareholders are not subject to self-employment tax on their income. Even though we're at a loss, there is no self-employment tax associated. There also is no capital account information here. It is on the shareholder to basically keep track of whatever money they've put into that entity for tracking purposes. And again, same concept with regards to his tax return. The only difference is there's no Schedule SE for self-employment tax. And the only difference is going to be this S with regards to reporting this entity for S corporation purposes. So, all right, Melissa, we can go back to the presentation. And just two other points that I want to cover before we move on to the other stuff. Estimated tax payments. This again is important. If you are not currently working and not having any withholding on any of your earned income or even your investment income, the IRS still wants its money throughout the year. And so you have to have paid in at least 100% of your prior year tax or 90% of your current year tax in order to avoid underpayment penalties. Now, if your adjusted gross income is over $150,000, then 110% of your prior year tax has to be paid in. And basically 25% of that amount needs to be paid in as of April 15th, June 15th, September 15th, and January 15th of that next tax year. So basically for the 2021 tax year, if you are required to make estimated tax payments, that first payment is going to be due in a month on April 15th. That should encompass at least 25% of either your prior year tax or 22.5%, which is 90% times 25%, 22.5% of your current year estimated tax. Next slide. Now it's on to Melissa.
Okay, thanks, Laura. All right, so we're going to spend a few minutes talking about sales and use tax considerations as a business. So just to kind of give everyone a high-level overview, familiar with sales use taxes, you pay them when you go and you buy goods at a store or a restaurant, and when you buy goods online as well. Historically, or generally, I should say, sales tax treatment across the states may vary, but for the most part, anytime you buy tangible goods, they're going to be subject to sales and use tax unless the buyer, the consumer, qualifies for a particular exemption based on the business activities or how the goods are used. In Illinois specifically, taxes due on sales of tangible goods. And they're also due on purchases of tangible goods. Illinois does not tax services unless there's some type of property being transferred with the service. But again, if you think about other states or selling into other states, that tax treatment might be different. Now thinking about the obligation to collect sales and use taxes in a state that you're selling into has significantly changed over the past 3 or so years. The standard used to be if you don't have property or employees or agents that are selling on your behalf in a particular state, then most states would say, well, you don't have an obligation to collect or charge sales and use tax. So if I'm in Illinois, I have no property or no employees, nobody soliciting for sales on behalf of my business outside of Illinois. Let's say they're in Indiana or Wisconsin soliciting for those sales, and I make sales into the state and I ship my goods for those sales into the state, then historically I would have not have had an obligation to collect because I have no physical presence there. And that was a constitutional standard. 3 years ago, that changed with a business case or a case against Wayfair by the state of South Dakota, which is called the Wayfair case. And basically, this is a case that was heard by the U.S. Supreme Court, where the Supreme Court said the standard of relying on physical presence in a state really is not, it doesn't apply any longer because that's not how business is generally conducted these days. So now they have allowed states to enact a legislation that allows them to say, if you make 100 sales into my state in a year, in the preceding year, or if you make $100,000 of sales into my state in a year, then you have an obligation to start collecting sales use tax from the consumers that purchase from you in that state. So that triggers an additional obligation beyond the state that you already have offices in. So that, as you can imagine, provides a lot of complexity with, how to keep up with that standard, how to make sure the business is charging tax, should they even be charging tax. So this next slide is a heat map of states that have enacted economic legislation. There are a few more states that are not represented here that have adopted that same standard recently, but you can see as soon as that Supreme Court decision was made, a lot of states were on board with requiring companies that are selling into their state to start collecting taxes if they've met certain thresholds. So now we get into the other side of things, which is the marketplace platform. So as a retailer, if you've engaged with a platform of some sort, or a company that has an online platform to sell your goods on your behalf, then that obligation to start or to bill collect tax may revert to that company, to that marketplace platform. I had mentioned the $100,000 or 100 transactions in a 12-month period. That same standard generally applies to marketplace platforms. So, and there's a couple of things to think about with, who has the obligation? Is it the seller or is it the platform? And things that you have to consider that states are adopting into their law is, well, is there a contractual arrangement? Who's processing the payment? Who's collecting it? Should it be remitted over by the platform, the marketplace platform, or should the retailer remit it? Who's going to tell me what the tax rate is? Who's going to tell me if what I'm selling is even taxable? And that can vary, the rates can significantly vary when you're talking about just standard sales of tangible, goods versus things like food and beverage items. So this second heat map is a heat map for marketplace providers. So while the states have adopted legislation to enact economic nexus, which would impact the retailer, this heat map is with respect to marketplace providers that are selling on behalf of the retailer on their platform. Again, a lot more states have enacted the requirement for marketplace platforms to start collecting tax for the seller. And this is basically the state's way to say, all the tax for the sales that are being made into the state where that consumer, that retailer is benefiting from selling into the state should be captured and can be captured by marketplace providers, where it wouldn't necessarily be captured by the remote retailer because they probably don't have that many sales into a state. How do states define who a marketplace facilitator is? Again, that can vary based on how they're contracting with the retailers, what exactly they're responsible for doing on behalf of the retailers. Do they have a partner agreement with those retailers, or are those platforms just selling goods for a particular retailer online that retailer has no knowledge of them doing? And the issue with that is that if you have a marketplace facilitator that's doing something and the retailer doesn't really understand or know what's happening, then that can open up a lot of issues with double taxation or with exposure as well. So having an understanding of what the requirements are, is important depending on where the business might be selling into. Again, this gets into a few scenarios with marketplace, platforms and how they transact sales, and retailers and what they should be liable for collecting and remitting. So while this might not have much of an impact on a business if they're not contracting with a marketplace platform, it's something to consider if a business is thinking in the future to start expanding their sales by partnering with a platform to sell their goods. So business considerations. I talked a little bit about tax rates and taxability, and a lot of things, or what I see and what we view when we work with clients in the food industry or in other industries, is that getting a good sense of taxability of what is being sold is pretty important. And in Illinois and Chicago, I can say specifically is that Chicago has a lot of different tax types that are applicable to, sales of food, sales of software, technology, things of that nature. And then getting really nuanced down to the line item detail on an invoice that you issue to a consumer, as well as where you're selling from and where the goods are going to. So thinking about, who's delivering the goods that are being sold, how is the payment being processed? Is it cash or credit that's being accepted as payment? And then getting into the taxability of what you're selling. So food is an example here. Is it available for immediate consumption, or is it something that would be considered a grocery item that you can sell and someone can prepare at home? The taxability of that will vary in Illinois and likely potentially in other states as well. Beverages, is there a Chicago tax due on top of an Illinois tax due on that? Packaging, delivery charges, service fees. I mentioned earlier, services generally not subject to tax in Illinois or Chicago, but that service fee, if it's lumped in with the sale of a good of food or other tangible items, could trigger a tax obligation as well. And Illinois and Chicago specific considerations. So just at a high level, some things to think about are the tax rates that would apply here. Obviously familiar with paying 10 and a quarter or maybe more in Chicago, depending on what you're purchasing. But at the very base level, you would pay, or the state would require that a business or a consumer would pay 6.25% on anything that they're buying, whether it be food, beverages, or other tangible goods. And like I said, that can go up to 10.25% or more, depending on where you're buying or where you're shipping to. You've got this Chicago home rule municipal soft drink tax, which is basically a Chicago tax on specific sweetened beverages that's enforced and collected by Illinois. So that's a tax that has to be collected on sales of those goods that are destined or purchased from within Chicago. This MPEA, which is a Metropolitan Pier and Exposition Authority food and beverage tax, similar to the soft drink tax, but this also includes food, and it's just within the MPEA boundaries within the city. And then, like I said, like 6.25% on food and beverage, it's the 6.25% on generally on tangible goods purchased for use in Illinois. For Chicago tax implications, in addition to Illinois that are specifically collected by the City of Chicago Department of Finance, there's an additional 1% use tax on tangible goods. And these rates, when I call them out, it's applicable to the consumer, but the vendor may be collecting it. So if your vendor, whoever you're buying from, for things that you're buying for use in your business is billing the tax, then it's just making sure that they're billing the correct tax, because they might not have the obligation to collect that 1% Chicago tax, for example. There's a 9% lease tax in Chicago for any equipment or goods that you are renting for use in the city of Chicago. And that 9% lease tax is also applicable to software. So if you're licensing any type of software platform or technology platform, there might be tax implications on that also from a use perspective. If you're licensing software for use, that's another thing to think about for Chicago. And then the restaurant tax, which is applicable only to restaurants that have an establishment in Chicago. Even if that food is not being eaten at the establishment, if it's being picked up and then delivered somewhere else, that tax is going to be due on that sale of food. And that is generally only the responsibility of the restaurant or the retailer, not the platform, if there was an arrangement with the platform and a restaurant for sales of those goods. This is pretty high level, right? Things to consider, your filing footprint. Where do you have an obligation? While this says, marketplace sales tax trap, this is something that retailers would have to consider as well, understanding where they might have an obligation. Are their tax decisions correct? Are there sales being made to an exempt entity, whether it be a charitable organization or other nonprofit or a government entity where perhaps your sales are not taxable? And then making sure that, you're paying the appropriate amount of tax on items that you're buying for use in your business. From a systems perspective, it might start off very manual or using, software to help manage accruals and reporting and billing and collection. But as there's an increase in expansion of sales of a business, then it can be, quite cumbersome and significant to manage manually. So there's a lot of systems and software providers that help businesses manage the tax obligations. And this here really just gets into a little bit of what I said, and what we see are some standards that some businesses may follow, keeping a matrix of taxability for what they sell and what they buy, ensuring you have the tax rates appropriately applied. Document retention is a big thing, making sure you keep your records for at least 3 to 4 years, sometimes maybe even 6 years or more, of items that records for sales and for purchases as well. Automation and structural considerations just to manage the compliance aspect for sales and use taxes. And then this is just a quick, case study of a marketplace seller and the complexity in their business, that they're a retailer, plus they're a platform. They don't have the means to be able to collect tax. So the potential company impact, obviously, I mentioned earlier, there could be overpayment, there could be under collection, there could be system issues, keeping track of the compliance for sales and use taxes, in Illinois, Chicago, and beyond. So yeah, and I think that wraps it up for now for sales use. Martin, I'll hand it over to you.
Melissa, thank you very much. And every time I hear Laura and Melissa do a presentation, I am just thoroughly impressed. But that brings me to another point. It would be very difficult to have all the skills that Melissa and Laura have. So I always try to work with my clients who are not tax professionals and advise them that they should treat tax the way they do many other business functions that they have to deal with. And what my suggestion is act like the executive, act like the business owner, where you're going to make some decisions about risk management. You're going to make some economic decisions about your cash flow, remitting the appropriate amount of tax, and you're going to identify folks that can assist you with the technical requirements in getting your tax compliance completed. And next slide, Melissa. So I put together a diagram that shows some of the responsibilities for employment tax matters. So as Laura went through the choice of business entities, keep in mind that even if you are the sole person within a business such as an S corporation or a C corporation, you will be filing employment tax returns and you'll be providing yourself Form W-2. The other business entities that Laura went through, the partnership, the LLCs, you would report that income on the K-1 in those that type of an arrangement. So what an employer needs to do is to make sure that they register in the jurisdictions where they have employment activity. That typically is going to be for state and federal purposes. and you'll need to register for not only state income tax withholding, but also register for state unemployment tax. The filing frequency for most states for unemployment purposes is on a quarterly basis. So the compliance is fairly rigorous. You want to make sure that you meet those deadlines. And then for federal purposes, you also have to file a quarterly 941 and make periodic employment tax deposits. And the frequency of your deposit is going to be contingent upon your size of the deposits. So small employers will typically make deposits by the 15th of the following month. Larger employers, they may be required to make deposits as frequently as the next banking day after they've run a payroll. Now, one thing that I would suggest is if you have a payroll, is you consider utilizing some of the third-party payroll processors. And if you were to Google, you would find many companies that would be able to meet your needs, Paylocity, Paychecks. Some of the bigger players are ADP and Ceridian, probably not very cost effective for you, but some of the smaller providers would suffice. And my experience has been that those costs are anywhere between $50 to $100 per month, depending on how many employees. That would be for a single employee or two employees, and then that price would increase as you have more and more employees. But it allows you to provide kind of a big company benefit for your employees, such as allowing them to have electronic pay stubs that they can access online, allows them to request direct deposit if you use the third party. And some of these third-party payroll processors will also provide some HR services, may offer some benefits that you can purchase and have your employees participate in. So maybe something worthwhile. And next slide, please, Melissa. And what I have here is a checklist when you're onboarding employees. One of the most important steps in the employment process is making sure that you gather the appropriate information from the individuals. Employers have an obligation to determine whether or not someone is eligible to work in the United States. They have an obligation to obtain the appropriate tax documents, such as the W-4, to calculate withholding on their wages. And all of this information, it's best if you gather that, when you hire these individuals, make sure that you've got that information so you can set up your payroll system. Next slide. And here I've included some links to very useful resources for small employers, give them some insights on what's required for employment activity, some helpful tips, how to register to make employment tax deposits through the electronic funds transfer system, and very helpful in making those determinations on what are your next steps as an employer. One thing I do want to be sure to mention is, in Laura's presentation, she talked about limited liability with corporations. There's one area where forming a corporation will not limit your liability, and that's with payroll withholding tax. So there's such a thing known as a trust fund recovery penalty which allows the IRS to assess 100% penalty on an individual that fails to remit the taxes that have been withheld from employees. So you might wonder, when would that be the case? And unfortunately, I have had clients who've made decisions instead of remitting taxes withheld from employees that belong to the Internal Revenue Service or the state jurisdiction. They decided to use those funds to keep the business going. So they felt that they had a cash flow problem, decided to delay the remittance, and unfortunately, that cash flow problem just became larger and larger, and they were never able to make that deposit. Well, there is no relief through a creation of a corporation if you're running your business and you fail to make those deposits. So be very careful and make sure that you put the appropriate effort into remitting your employment tax deposits. And next slide, Melissa.
Okay. I think we're at the end of our presentation, Esteban. And I saw there were probably a couple questions, right?
Yep. Thank you everyone so much. Laura, Martin, Melissa, that was a great presentation. Lots of really good content there. I'm sure a lot of our small businesses will find it really, really informative. And we did have one question just to clear it out of the way for the rest of our attendees. This is being recorded, and the presentation recording will be sent out afterwards, after it's done processing by Zoom. So we did have one question. We have a couple. The first one is, if I have an online business where she sells consultant knowledge, or she's essentially a consultant service company, how can she determine the type of good that she would be selling as a service company like this? And what's the sales tax procedure, or what kind of sales tax?
Sure. So as a service provider, if that's all that's being done as a consultant and there's not any tangible good that is being provided with the service, there would be no sales tax implications. And when I say that, you might print a report, right, that is provided to a client, whoever you're providing the consulting service to. And basically, thinking about paper, as long as you're paying your provider that you're getting the paper from, sales tax, then that's like your use tax, that's your consumption tax that you have to pay your vendor, or you pay to the state if the vendor is not billing it. But if there's no tangible good in Illinois that's being provided with the service, then there would not be any tax to this. Treatment of that, though, may vary in other states.
Mm-hmm. Yeah. So accounting or consulting based on your knowledge, for instance, wouldn't be a tangible good.
Right.
Okay. Perfect. Then we had one more question so far, which is, this one's a little bit, I don't know if any of you have heard of the recent news from Governor Pritzker, saying that there's going to be a federal tax decoupling from Illinois. And what your, I guess, first impressions are of this, because a couple of our clients have had this question.
And I wouldn't mind taking this one, Laura and Melissa. So the issue is, for many states, they have conformity with federal provisions. And what that means for taxpayers, especially taxpayers that have multiple presence throughout states, is it does provide some ease in administration and filing, because they can rely on what's going to be federal taxable income is likely going to be their state taxable income, plus or minus some types of adjustments. Now, with the Tax Cuts and Jobs Act, there's been some decoupling, just in the sense that you no longer have allowances on your return, but states will still use them to calculate your state income tax. So if the question is this something that's good or bad, I wouldn't necessarily say it's good or bad. Other than it makes it a little more complex because you've got another set of provisions that, another accounting and bookkeeping requirement, if there's a difference in depreciation methods, you'll have to do that at the state level. But your concern is what is the tax cost as a result of the decoupling and those particular state provisions. Anything to add, Laura or Melissa?
Nope, I think you covered it, Martin.
Perfect. Well, I think that's all of our questions that we've had so far. Last one being if our attendees could have a copy of the presentation of the PowerPoint.
Yeah, we'll get that over to you to distribute as well.
Perfect. Appreciate it. Yeah, really great information here. Really appreciate the presentation and just how much really great content is here, and it's broken down so well. So again, really appreciate it. I'd like to thank you all for coming out today, this morning.
Okay, thank you very much.
Thank you.
Have a good
Yep.
day.
Bye-bye.
Thank you, everyone.
Bye.
Bye. And yes, it'll be sent via email.